Welcome back to our financial statement analysis reading between the lines video lecture. In this video, we are going to identify the differences between personal and business financial statements. In addition to business financial statements, forensic accountant engagements commonly require the consideration and analysis of personal financial statements. Personal financial statements, similar to business financial statements, serve to provide information about an individual's financial condition, income profile, and cash flow. They are commonly required by banks and other creditors to support loan applications or other requests for financing. Generally, a personal financial statement consists of a single form that reports an individual's personal assets and liabilities, as well as personal sources of income and expenses. The nature and extent of this form is determined by the organization, the bank, or the vendor that is supplying the credit. However, personal financial statements compiled or reviewed by an accountant should be accompanied by a written report. That written report serves to qualify or limit the accountant's level of assurance and responsibility for the financial statement. Similar to a company's balance sheet, a personal balance sheet provides a snapshot of an individual's financial condition at a specific point in time. Contrary to those rules employed in the preparation of business financial statements, specifically GAAP or the cost principle, personal financial statements present assets at their estimated current values and liabilities at their estimated current amounts. But similar to a company's income statement, a personal income statement prepared on the cash basis serves to provide information regarding an individual's cash inflows and outflows over a period of time. Cash inflows include salaries, dividends, interest, capital gains, rental income, and so on. And cash outflows might include all living expenses like your rent or mortgage payments, car payments, utilities, bills, food, clothing, and entertainment. A personal income statement discloses an individual's net cash flow, cash inflows minus your cash outflows. Banks and other third parties use this information to measure the capacity to manage current and/or proposed debt. Personal financial statements represent affirmative statements made by the submitting party and as such provide evidence for consideration or analysis by the forensic accountant. So 3 common forensic accounting engagements that commonly require the analysis of personal financial statements include domestic relations, embezzlement or fraud, and arson. So in domestic relations or divorce cases, the analysis of personal financial statements provides significant content for the forensic accountant. So these statements measure an individual's net worth or wealth on a specific date. In an embezzlement or fraud allegation, the analysis of a personal financial statement may provide support or lack thereof for alternative theories explaining the acquisition or expenditure of cash. And the motive is a critical element in an arson or insurance fraud case. So a common motive alleged by insurance company in denials of claims in financial distress on the part of the claimant. So to support or refute this allegation, forensic accounting experts for both sides will analyze the personal financial statements to identify indicators of that financial stress. And this concludes our full financial statement analysis lectures. Thank you for watching.